You know that feeling? You're juggling things. Maybe you've got a personal loan, those interest payments just ticking along.
Hmm.
And on the other side, you've got some investments, and you're really hoping they're, going to grow.
Yeah, doing their thing.
Exactly. Then that little voice pops up. Should I maybe cash some of that investment money out? Just be done with this loan.
Oh, yeah, that's a common one. A real head scratcher, like you said.
I bet a lot of us can relate.
Absolutely. And it feels complicated, but really it boils down to a kind of trade-off, doesn't it?
How so?
Well, it's the certainty, the guarantee of getting rid of debt versus the potential for your investments to grow more.
Right, potential being the key word there.
Exactly. And what's really helpful, I think, is actually breaking down the numbers, seeing which path might realistically make more sense for you.
That's precisely where we're headed today. We found this fantastic guide that really gets into this specific dilemma. Yeah, it uses a really practical scenario, clear figures. Think of it as maybe a shortcut to understanding the real nuts and bolts.
Okay.
So we're going to explore, what happens if you just keep paying the loan, let the investments ride,
Option A.
versus option B, sell off those investments, wipe the debt slate clean.
Get it gone.
Yeah. The goal here is really just to pull out the key insights so you can see the actual, real-world consequences of each path.
And that's so valuable because grounding it in a tangible example with actual numbers,
Yeah.
it makes it much less abstract, right?
Totally. It's not just vague advice. It's something you can almost map onto your own situation.
Exactly. Easier to follow.
Okay, so let's paint the picture.
Yeah.
The guide sets up this loan scenario. Imagine someone borrowed $11,050,000.
Okay. Decent chunk.
Yeah. Interest rate is 10.75% per year, and it was a 5-year plan originally.
Standard sort of personal loan setup.
Right. But here's where you are in the story. 2 years have passed. 24 payments, 24 EMIs already made.
Okay, so some progress.
Some progress. But that leaves a remaining balance of €7,050,000. And that needs paying off over the next 3 years. So 36 more payments.
Got it. 36 EMIs left.
Yeah.
And EMI, just quickly, that's Equated Monthly Installment.
Right. Simple enough.
Yeah, it's that fixed amount you pay each month. Covers both the interest and paying back a bit of the original loan, the principal.
Yeah. Mm-hmm.
But what's interesting, even after 2 years of paying, a good chunk of what you'll pay over these next 3 years, still interest.
Really shows how that interest keeps adding up, doesn't it?
It does. It's the cost of borrowing spread out.
Okay, and here's a detail that's super easy to miss, but really important.
What's that?
The prepayment penalty.
Ah, yes, the tatch.
Exactly. If you decide, right, I'm paying off this remaining $7,050,000 now, the bank hits you with a fee.
And how much is it in this example?
It's 3% of that remaining amount. So 3% of $7,050,000 works out to $22,500.
Oof. Okay, so that's an immediate cost you have to swallow if you want out early.
Right. Straight out of pocket. It's a key factor in the whole pay it off now calculation.
Absolutely crucial point. It's that upfront hurdle. Okay, so that's the loan side. Let's switch gears, look at the investments.
Yep. So the guide cleverly keeps the numbers parallel. It assumes you currently have $7,050,000 invested. Stocks, let's say.
Right, mirroring the loan balance makes the comparison direct.
Exactly. Now, the big question with stocks is always the return, right? What are you actually going to make?
The $1 million or, well, maybe the 10 lakh question.
Yeah. So the guide uses an assumed return based on historical averages of 12% per year.
Okay, 12%. But that comes with a big asterisk, obviously.
Huge asterisk. Past performance, not a guarantee. Market goes up, market goes down, all that.
It's not like a fixed deposit giving you exactly 12% year on year. It's an average expectation.
Correct. So it's just a reasonable estimate to help us project things and compare the two options.
But yeah, the real world can be very different. Higher, lower. Could even lose money some years.
True. You need to keep that risk factor in mind.
Definitely. And the guide also brings in something else vital. Taxes.
Ah, yes. Can't forget the tax man.
Never. So when you eventually sell those stocks, if you've made a profit, well, some of that profit might not be yours to keep.
Right. You could owe long-term capital gains tax, LTCG. Let's break that down a bit.
Please do.
So if you've held the stocks for more than a year, any profit you make above 1 lakh rupees in that financial year, that gets taxed.
And the rate.
In this guide's scenario, it's 12.5% on that gain over 1 lakh.
Okay. And what if it's short term? Less than a year.
Then it's higher. Short-term gains tax is 15%.
So holding longer generally gives you a slightly better tax rate, but still, it eats into your profit.
Absolutely. It definitely affects the net return you actually pocket.
Okay. So now we've got the pieces, right? Loan details, that penalty, the investment, the potential return, the tax bite.
Yep, all laid out.
So let's dive into option one. Keep making those EMI payments. Just continue as you are.
And keep that 7,050,000 buys invested in the market.
Exactly. Let it ride.
Okay. So what does that look like over the next 3 years? Well, you've got those monthly EMIs, roughly 24,500
No?
times 36 months. You end up paying a total of about 8,082,000 more to clear that loan.
Right. And how much of that is interest?
The guide estimates that over these final 3 years, about 1,032,000 of that total is just interest cost.
Wow. Still quite a bit, even towards the end of the loan.
Yeah, it really highlights the ongoing cost of that borrowed money.
It does. Okay, so that's the outflow. What about the potential upside, the investment?
Right. That's $7,050,000 sitting in stocks. If it grows at that assumed 12% average per year.
For those same 3 years.
Yep. Using a standard future value calculation, it could potentially grow to around 10,053,600.
Okay, so a noticeable increase there.
Definitely. If you started with 750K, it could become, over 10.5 lakh.
That's a capital gain then of what, about 3 evals, 3,600?
Roughly, yes. But wait.
Uh-oh. Taxes again?
Taxes again. Assuming you held for over a year, you owe that LTCG tax on the gain above 1 lakh.
Right. So on about 2,03,000 of the gain.
Exactly. And based on these numbers, the tax would be around 25,450.
Okay, so you subtract that from the total value.
Yep. So after tax, the net value of your investment might be closer to 10,028,150.
Got it. So comparing that net value back to your initial euro $50,000.
You're looking at a potential net gain from the stocks of around 2,078,150.
Okay, but that's before you account for the fact you were still paying nearly 9 lakh on the loan during that time.
Crucial point. This is just looking at the investment growth in isolation for a moment.
Right. Okay, so that's the picture if you keep everything going. Now the alternative, option 2.
Option 2, sell the stocks now, take that money, pay off the loan immediately, be done with it.
Okay, what's the immediate hit?
Well, you owe $7,050,000 on the loan, plus
that penalty, 22,500.
Bingo. So to clear the debt today, you need to find $7,072,500 in cash.
Which comes from selling those stocks.
Exactly. So the big thing you're doing here is giving up that potential future growth we just calculated.
Right. You're foregoing the chance for it to become that 10,128,150 after tax.
Yeah. The guide calls this the opportunity cost. It's what the money could have done.
And that difference, the potential gain you're missing out on compared to the immediate payoff cost, is around, what, 2,055,000?
Something like that, yeah. That's the potential upside you sacrifice.
Okay. But there must be a benefit to paying it off now.
Oh, absolutely. A very real, very tangible benefit.
Which is?
You completely stop paying interest. Immediately.
And we said that interest over the next 3 years was estimated at 1,032,000.
Exactly. So by paying off now, you save that entire amount. It's money that stays in your pocket.
That's a guaranteed saving, unlike the stock market's potential gain.
Precisely. So let's look at the net effect of prepaying. You save 1,032,000 in interest.
But you pay the euro 22,500 penalty.
Right. So the net financial gain from prepaying in terms of saved interest is 1,009,500.
Okay, so the outcome here is loan's gone, stocks are gone. But you are definitively better off by 1,009,500 because of the interest you didn't have to pay.
That's the summary. A very different financial position compared to option 1.
Totally different. One leaves you with a potentially larger asset, but ongoing payments for a while. The other leaves you debt-free immediately with a smaller but guaranteed financial saving.
Okay, let's try to put these side by side really clearly. The guide does a good job summarizing.
Yeah, comparison helps.
Option 1, keep paying EMI, keep stocks. After 3 years, loans done. Stocks might be worth, say, 10,028,150 after tax. You've paid out 8,082,000 in EMIs. The stock gain itself was potentially around 2,078,000 net.
Okay, option 2, prepay now.
Loan gone instantly. Stocks gone instantly. You paid out 7,072,500 upfront, loan plus penalty. Your net financial benefit is that guaranteed interest saving of 1,009,500.
And the risk profile is totally different.
Hugely different. Option 1 has market risk that 12% isn't guaranteed. Option 2 has zero market risk going forward, and the saving is locked in.
It's interesting. If you just look at the raw numbers, 12% expected return versus 10.75% interest cost.
You'd think keep the investment.
Right. The math seems to favor staying invested slightly, but then
Taxes.
and that prepayment penalty up front for option 2, Once you factor those in, the gap narrows, doesn't it?
It really does. And this is where the guide rightly points out. It's not just about the pure math.
Absolutely not. The psychological side is huge here.
Yeah. How do you feel about debt? For some people, just being debt-free, the peace of mind.
Oh, it's massive. That feeling of it's gone, I don't owe anyone, that has real value, even if it's hard to quantify.
Totally. They might sleep better at night, less financial stress, worth more than a few potential percentage points gain.
Definitely. But then you have others who are maybe more comfortable with risk. They see the loan as just leverage, maybe.
Right. They think, my investments are likely to earn more than the loan costs, so I'll ride it out for potentially higher returns.
And they're comfortable with the market potentially they have that higher tolerance for volatility.
So it really brings up that personal question for you listening, doesn't it? Where do you sit on that spectrum?
Yeah.
Yeah.
Debt averse. Or comfortable with calculated risk for growth. How much do market swings bother you?
Your own gut feeling, your comfort level. It's a massive piece of this decision.
Crucial. Can't ignore it.
And the guide makes another really good point. It's not necessarily strictly option 1 or option 2, black and white.
The middle ground.
Exactly. A smart middle path, they call it. Maybe you could partially prepay.
How would that work?
Well, maybe you sell some stocks, pay off a decent chunk of the loan, maybe half of it.
Okay, so you reduce the debt burden, lower the interest payments.
But you still keep some money invested, exposed to potential market growth.
Kind of hedging your bets.
Sort of, yeah. Or another angle. Maybe you don't sell stocks at all, but you find ways to increase your EMI payments.
Attack the principal faster.
Right. If your budget allows, paying more each month shortens the loan term, reduces the total interest paid.
Without sacrificing your investment position. That's interesting, too.
So these hybrid approaches offer flexibility, right? Tailoring it more closely to your specific situation and risk comfort.
Yeah, that makes a lot of sense. Not always all or nothing. Finding that balance.
So, quick recap then. Main choices. Stick with stocks and EMIs, potential for higher gains, but comes with market risk.
Option 1.
Option 2. Prepay the loan, now guaranteed interest saving, peace of mind, debt-free feeling, but you miss potential stock growth.
The certain to option.
Or consider that middle ground. Partial prepayment or higher EMIs.
The balanced approach.
And the guide apparently used some visuals, which sound helpful, like a graph, maybe showing that potential stock growth line going up steeper than the flat line of saved interest.
Yeah, visually reinforcing the potential upside of option 1.
But then maybe another visual, like a pie chart, showing how much of that gain actually gets nibbled away by tax.
Right, tempering expectations. Visuals can really drive the point home sometimes.
Definitely. So what are the absolute key takeaways here? What should you remember from this deep dive?
Well, first, loans cost money. Obvious, maybe. But that interest rate, 10.75% here, is a real ongoing cost.
Got it. Second.
Stocks offer potential growth, that 12% example, but it's never guaranteed. Risk is part of the deal.
Okay.
Third,
prepaying saves you guaranteed interest. That's a sure thing. But it means giving up that potential investment gain, opportunity cost again.
and fourth,
Don't forget taxes. They impact your actual take-home profit from investment.
right, and the big one.
Ultimately, the best choice is personal. It really hinges on your individual situation, your tolerance for risk, what your financial priorities are.
Peace of mind versus potential profit.
Exactly. Weighing the potential rewards against that feeling of security. There's just no single right answer for everyone.
Couldn't agree more. So as you think about your own finances, maybe it looks like this example, maybe it's different. Use these concepts. Think about your loan rate, your investment expectations, the tax rules that apply to you.
But maybe most importantly, tune in to yourself. What provides you with more comfort? Is it being debt-free?
Or is it the possibility of building more wealth through investing, even with the risk? What feels like the right balance for you right now?
That's the question to ponder. And that's our deep dive for today.